Get started. Again, good morning. This is Adam Goldstein, the Chief Business Officer at the Federal Home Loan Bank of New York, and we welcome you to today's webinar. Just a few quick notes before we get started. If you have any questions, please submit them at any time through the question box, and they'll be answered at the end. As a response to the COVID crisis, we've created these webinars to bring educational content and kind of bring us all together in this remote working environment. In August, the focus will be centered around strategic planning. On the 13th of August, we will do a webinar on strategic planning as it pertains to technology. And then on the 27th of August, we will do a strategic planning session on ALCO meetings and restructuring your ALCO meetings, suggestions for how you can manage that. As always, we're looking to continually enhance the program. So if you have any questions or suggestions, please complete the survey, which will come up at the end of the webinar. We also, as always, encourage you to visit our Financial Intelligence Library, where you can listen to feature podcasts on LIBOR and SOFR and other topics, lots of articles, recordings of past webinars as well. We'll be sending out an email with a recording of this particular session, as well as a link to download the presentation at the conclusion of the webinar. The materials from this webinar will be posted also on the Financial Intelligence Library. There's a page on our website dedicated to COVID-19 information. We upload information to that almost daily. So there's lots of stuff that we encourage you to take a look at: dividend announcement, PPP, eligible collateral. We have some new funding going in for the Homeowner Dream Program on Monday, August 3rd, and again on Tuesday, September 1st. All the grant programs, information on that, and funding availability is all listed on that site. We recently announced that our new secondary market outlet for members, the Mortgage Asset Program, is set to launch later this year. Last week we hosted 2 webinars, but we will host 2 more next week on Monday, July 27th, for those that are not currently delivering loans in the MPF program, and then one on Wednesday, July 29th, for members that are currently delivering loans in the MPF program. And that one is essential if you are a member that's delivering loans, because later this year we will be converting to the new program. So you definitely want to get yourself up to speed on the new program, which was developed based on feedback from members, and we were happy to go through that with you. If you are a member that's selling loans, actually today or tomorrow, you'll be receiving a package of information with the guides, forms, and agreements, and your relationship manager will be calling you to set up a meeting to go through all that with you. And then finally, we're working hard to launch a business development advance aimed to encourage job opportunities in small businesses through 0% financing, 0% advances for our members to support their small businesses in their community. So we're trying to do our best to help everybody out during this very difficult time. And we wish you all and your families well during this difficult time. And with that, I'd like to introduce Tom Citino, our Vice President and Director of Member Relations, to introduce today's webinar. Tom, take it away.
Thanks, Adam. Good afternoon or good morning, everybody. Appreciate everyone attending today. Just want to introduce Janet Lockwood, a friend of mine and the bank's. She's worked with many of our members. Many of you may already know Janet. She's been conducting strategic financial planning workshops through her work at Parliament Consulting with our bank for many, many years. I believe it dates back to our first session in 2007. So Janet currently, as her role in Parliament Consulting, she works with community banking organizations across the U.S. And like the topic says today, she specializes in strategies to segment and differentiate deposit products where you can lower your cost of funds, retain and grow large deposit relationships, and also to provide strategies to increase share of wallet with your depositors and your customer base. Prior to Parliament Consulting, Janet has other ALM management experience, asset liability management experience. She worked at Eastern Portfolio Group, an investment portfolio and ALM firm. Also, Janet worked at Farron & Associates. Many of you may know of them. They're also an AL management consulting firm. And for the majority of Janet's career, she worked at a sister bank. She worked at the Federal Home Loan Bank of Boston for many years. She managed a sales and business development team there. So with all that being said, it's a pleasure to introduce Janet, and I'm going to let Janet take it away.
Okay, thank you, Tom, and thank you to the Federal Home Loan Bank of New York for this opportunity. Good morning, everyone. For those of you who participated in Dr. Tom's loan presentation a few weeks ago, he discussed the need for you to grow your institutions through loans, which are priced on a cost and risk adjusted basis. He acknowledged that during this pandemic, you may tactically choose to slow down your loan growth a bit, but strategically, you need to grow. That's how you grow your income. Given this strategic loan growth, you'll need to retain and grow your deposits while always using Federal Home Loan Bank advances strategically. Next slide, Alyssa. All financial institutions are retailers of financial services. Your loans and deposits are commodities offered by non-depository institutions. So in order to compete effectively and to minimize your balance sheet cannibalization, the retailing tools of market segmentation and product differentiation are critical. You'll hear me repeat those terms ad nauseum. This means that you need to understand the profile of your larger balance customers. Now, I'm not saying that small balance customers are not important, but large balance customers can swing your deposit balances. Understanding customer profiles will help you project the rate sensitivity and the products that you need in any rate environment. And the analytical tool to start a customer profile is a Decile distribution. Next slide. The first step in market segmentation and product differentiation is to evaluate a Decile distribution by individual deposit type. It's the first step to segment large balance customers from small balance customers. One reason for segmenting by balances is that large balance customers, as I said before, can swing your balance sheet deposit total. And another reason, and a very important one, is that higher balance customers are typically more rate sensitive. Not always, but typically they are. So we need to be able to estimate the rate sensitivity and product needs in order to retain those balances and then also to reach out to them to get a wider share of wallet and more balances. As you review the top deciles representing high balance customers, there's several questions that should be answered in order to build a profile. And again, this profile is to better estimate rate sensitivity and product needs. So the questions you see in front of you, the bullet, how long have the balances been with you? Has the product mix held by these customers changed? What is the share of wallet? And how much of their deposit and loan balances do you control? You do want to understand with your depositors what loans you also have with them. Do you have their primary transaction account? That's checking, the sort of the holy grail of banking. Do you control their mobile banking relationship? What are the demographics of your large balance customers? And this is important because for older customers, do you have relationships with household members? Senior citizens, as they die off, what's going to happen to the balances that you hold for them in your institution? We understand that for some institutions, you may have system restrictions that limit your ability to easily run a customer information file report in order to answer these questions. Hopefully, you can work around that with supplemental software, or certainly work with your core processors to help you develop those kind of systems if you don't yet have them. Next slide. This, thank you. This example reflects money market data, which was dumped into an Excel spreadsheet, which gave me 4,558 rows of data, because that's how many accounts I have. I sorted the balances from high to low, and then divided by 10 equal segments, or deciles. This particular file that I worked with does not include customer names or account numbers, but your data file would obviously identify them because you have to know the names behind the balances. In this example, we have 4,558 different money market accounts that total almost 180 million. The average balance is just over 39,000. The median balance of just over 15,000 reflects that half of your depositors, which is 2,283 accounts, have balances of $15,147 or less. This is not a number, this median is not a number that management typically evaluates. These lower balance customers, although reflecting many accounts, over 2,000, hold only 8.2% of balances. We can assume that their rate sensitivity is probably less than the rate sensitivity of your higher balance customers. Now, having said that, I recognize that we could have one customer, Mrs. Smith, who has 3 or 4 money market accounts, which total a high balance. I can't see that through just this empirical data. But if she has a lot of accounts that total higher balances, her rate sensitivity may be high. That's why developing a customer profile is so important in order to determine the entire relationship of products and balances. So let's look at the top decile, which contains 455 accounts. The total balances are 92 million and an average balance of 203,000. A median balance of almost 160,000. This top decile contains almost 52% of all balances. So who are these customers? That's what we want to focus in on. Again, we can make the assumption that they'll have a greater rate sensitivity than lower balance money market customers. But that's where that whole profile comes in and understanding an entire relationship. To further segment the higher balance customers, I could run a decile distribution of just the 455 accounts that are in that top decile. Or I could just look at my Excel spreadsheet and do some quick calculations, which is what I did. So if you look at the bottom of this slide where I have the bullet, I show 3 different calculations here. I totaled 2 customers with balances $1 million or more, which total $3 million. 88 customers with balances between $250,000 and $1 million, totaling $34 million. And 359 customers with balances between $100,000 and $250,000, a total $55 million. 449 customers hold $92 million in money market. Now, when Dr. Tom and I work with our clients, for the most part, when we're sitting across the table from one another, they don't know who these customers are. And that's okay, that's understandable. But when you're fighting for deposit balances, we do need that profile in order to estimate the rate sensitivity and the product needs. So we're going to start with looking at the high balance customers. So we build a profile, and at a minimum, I would suggest that you include all customers with balances of $250,000 or more. That makes it a little bit more manageable for you and your people. In this scenario, it's the 90 customers. The 2 customers with balances greater than $1 million and the 88 million customers between $250,000 and $1 million. So we can start with the profile of these 90 customers. And if Alyssa, if you could go back to slide 3 for a second. With those 90 customers, we need to answer at a minimum these questions to understand what their activity in your institution has been over a given time period. Okay, we can go back to slide 4. So again, understanding these high balance customers will help us estimate rate sensitivity and product needs. And this Decile distribution is an excellent first step in market segmentation and product differentiation. Now, this should be performed for each of your major deposit types. Here, I'm showing just an account called money market. But if you have 3 different money market accounts, you should be running a Decile distribution for each one. If you have several savings products, run a Decile distribution for each one. And with checking accounts, run a Decile distribution for each checking account. This, for checking accounts, you should also include your non-interest bearing checking accounts, as you want to estimate when balances may move to an interest bearing account. And I'm looking at non-maturity deposits here, but you should be doing the same thing with your CDs, running a Decile distribution. I should note here that this analysis should be segmented by consumer accounts versus business accounts. Next slide. Slide 5. Go back one more slide. Okay, thank you. For purposes of this webinar and its time constraints, I'm focusing on non-maturity deposits, but obviously CDs are very important, and the analysis for retaining and competing for high balance CD customers will be the same. In order to more efficiently manage our cost of funds, one of our objectives should always be to pay up for rate-sensitive balances, but not for non-rate sensitive balances. This will require you to develop new products which have higher rates for higher balances. Yes, this is fair. Your consumers are very acceptable of unit pricing. That's why Costco and Sam's Club are so popular. They pay a lower unit price for a larger volume of product. Or some consumers clip coupons. Or they buy a shirt from Macy's only when it's on sale. My point here is that your customers will self-segment their rate sensitivity and will be understanding of higher balance products that have higher rates. A significant analytical tool to evaluate the impact of shifting balances and customer rate sensitivity is marginal cost or savings analysis. We'll cover this in the following slide, but our objective and your ALCO mantra should be to fund your balance sheet at the lowest marginal cost. By doing so, you'll see where the use of Federal Home Loan Bank advances becomes a critical strategic option for you. Next slide. Marginal cost or savings will evaluate how to fund your institution at the lowest marginal cost while managing the average cost of funds. This is critical because your profit margins on the asset side, your loans, are being squeezed due to competition. Therefore, we need to squeeze out every bit of profitability on the liability side that we can in order to preserve our profit margins. Full disclosure here, marginal cost and savings analysis can be a time-consuming exercise. It's driven by assumptions of rate sensitivity and changing product mix. In that way, though, it's similar to how you produce your budgets or interest rate risk projections. It's really the same thing. But it is the only analysis that will project the true cost of your product pricing decision. The marginal cost or savings is not a number that will flow out of your accounting system. Those systems show you average or historical costs, which are obviously good to know and very useful, but they are not efficient for product pricing. Marginal cost is not intuitive, but you do evaluate the elements all the time in your pricing committee meetings when you discuss potential rate changes, potential retention of balances, desired new money, and potential change in the mix of balances. So marginal cost, what marginal cost does is formalize this process and thinking. So it's helpful to think of marginal cost that way. It's already what you do, but it's formalizing a process. It does require assumptions on rate sensitive versus non-rate sensitive customers. That's why we segment high balance customers, as they're typically more rate sensitive. Does require the retention of current balances and therefore at-risk balances. The changes in the mix of deposit types. In other words, the balances moved from non-maturity deposits to CDs. The checking balances moved to money market. And the cost of raising new money, which is critical because we have to grow. And we have to grow at the lowest marginal cost. Marginal cost and savings analysis are measured by evaluating two different scenarios that calculates the change in interest expense divided by the change in balances. And it evaluates the benefits of combining wholesale funding, which for most of you is Federal Home Loan Bank advances, and combining them with organic deposits. Again, I know I'm repeating myself, but our goal is to fund the institution at the lowest marginal cost. And by the way, this analysis is excellent documentation to show examiners your thought process and exactly how you price deposits and why you would use advances to help supplement organic deposit growth. Consider that the nominal deposit rate may be lower than the advances rate, but what about the impact to your cost based on a changing deposit mix? The marginal cost of using just organic deposits may be much higher than the nominal cost of advances. And this is what's measured through marginal cost analysis. Next slide. As you know, we're in a very low rate environment, but given that, do we still have the ability to squeeze out additional profitability by lowering rates on non-maturity deposits? Our scenario that we're going to look at is a $500 million portfolio of non-maturity deposits. That's money markets, checking, and savings, with a weighted average cost of 25 basis points and an annualized interest expense of $1,250,000. Can we lower rates across all product lines and reduce our weighted average cost of funds from 25 basis points to 15 basis points, or a reduction of 10 basis points? Next slide. Okay, for purposes of this webinar, as I said, I combined all of my non-maturity deposits into one line item. That's money markets, checking, and savings. In reality, you would not do it this way. You would evaluating all products on separate line items using different balance retention assumptions. And you would also include maturing CDs, which typically those CDs that are maturing over the next 2 to 3 months, which need to be repriced and retained. Along with the costs and balances, you would also project product mix changes. You know, do some non-maturities move to CDs? Does checking move to money markets? Or all of this impact your cost of funds? In scenario 1, the blue section shows the $500 million of non-maturity deposits, the current weighted average cost of 25 basis points, and the annualized interest expense of $1,250,000. If we look at the green section, we're looking at lowering the rates across all product lines to a weighted average cost of 15 basis points. And my assumption here is that we're going to retain all deposit balances, 100% retention of balances. So if we look at the white section below, the results of retaining the $500 million at a lower weighted average cost of 15 basis points has a reduced annualized interest expense of $500,000. So that's our savings. if we retain 100% of the balances. Next slide. Thank you. Okay. Scenario 2 reflects our starting portfolio in the blue section. That's the $500 million at 25 basis points and annualized interest expense of $1,250,000. The green section now reflects our alternative scenario of lowering the weighted average rate to 15 basis points, but retaining only 90% of the balances, or $450 million. We might have said, well, what if we retain 80% or 85%? Those are scenarios that you would want to run, but probably in today's environment, looking at a retention of 90% with an at-risk of 10% is probably more realistic. Other rate environments, you'd certainly look at much lower retention. So this $450 million that we retain can be considered non-rate sensitive balances, as they did not move even though we lowered our rates by 10 basis points. So for right now, we're considering them non-rate sensitive. But 10% of our balances, that's $50 million, are at risk. Now, you might decide, depending on what your strategies are, you might decide to let them run out of your institution. But for right now, we're going to look at what's the marginal impact of this scenario. But it's worth knowing that customer rate sensitivity changes based on the level of interest rate and the speed with which interest rate movements occur. So the rate sensitivity that you experience today is probably going to be very different if rates were 200 or 300 basis points higher. I know you know that, you've experienced all of that. So the level of rates and the speed with rate movement all has an impact on rate sensitivity. We can see in the white box scenario comparison, remember for marginal cost or savings, we're comparing two scenarios. The reduction of $50 million of balances reflects the 10% of at-risk balances. We went from $500 million to $450 million. The reduction of our weighted average cost of funds from 25 basis points to 50 basis points, or a negative 10 basis points. And we had a reduction of annualized interest expense from $1,250,000 to $675,000, or a reduction or saving of $575,000. Marginal cost or savings, and you see this definition to the right of that white box, is the change in interest expense divided by the change in balances. In this example, we have the change in interest expense of a negative $575,000 divided by the change in balances, which is the negative $50 million, for a marginal savings of $115. That's because it's a negative over negative equals a positive number. By lowering our average rates by 10 basis points and retaining 90% of our balances, we realize a marginal savings of $115. Another way to think about this is that it would cost us $115 at the margin to hang on to the $50 million at-risk balances if we didn't move those rates down by 10 basis points. And the reason that we have the savings here is because we were able to hang on to the $450 million of non-rate sensitive balances, even though we reduced our rates by 10 basis points. So those non-rate sensitive balances become very, very crucial, very important. I have to emphasize here that you will not see this impact of pricing anywhere in your accounting system. Marginal costs and savings are not the easiest concept, but remember, it's the only method, one of the only methods to calculate the impact of your pricing decisions. Now, assuming your strategy is to grow your institution, you probably don't want to run off any deposits. There are many deposit strategies that can be implemented to hold on to the $50 million of rate-sensitive balances while not paying up for the $450 million non-rate sensitive balances. For example, we could create a new elite money market product, which pays a higher rate for higher balances. Or we could offer a special CD at a higher minimum balance and shut it down when we get the $50 million that we need. So by evaluating all of this in a marginal cost model, we can see what strategy will produce the lowest marginal cost for us. Or, and this is important, you may evaluate the benefit of using Federal Home Loan Bank advances to replace more rate-sensitive balances. As of yesterday, July 22nd, 3 to 5 year fixed term and rate advances had a cost of 57 basis points to 74 basis points. So based on your assumptions of rate sensitivity and therefore at-risk balances, as well as your projections of product mix assumptions, the nominal cost of advances may be much lower than funding with 100% organic deposit. Unfortunately, we don't have the time to get into these alternative strategies in this webinar, but you do need to understand the cost of retaining balances with different pricing scenarios at the margin. Something worth mentioning at this point, as you know, you always back test or variance test your budgets and interest rate risk models. You would want to do the same if you run marginal cost analysis. So looking at this spreadsheet in front of you, by adding onto this spreadsheet to the right of that green box, you could create a section that shows the actual balances and product mix after a period of 1 month or 2 months, and back test what actually happened, your actual versus projections. Again, the same way as you do with your budget and interest rate risk projections. Next slide. Okay, so on this slide, I calculated several what-if scenarios using a matrix. Again, it's not dissimilar to what you do with your budgets and interest rate risk projections. You run many what-if scenarios and make a decision based on a spectrum of what-ifs. So I started with the first scenario we evaluated, the $500 million of non-maturity deposits at a weighted average cost of 25 basis points. We reduced the weighted average cost to 15 basis points and retained 100% of the balances, resulting in a savings of $500,000 annualized interest expense. We also looked at the second scenario, where we retained 90% of the balances, or $450 million, a decrease of $50 million of rate-sensitive balances. However, we saved $575,000 of annualized interest expense, or a marginal savings of $115,000. I then evaluated assumptions of balance retentions from 80% down to 50%, the resulting change in balance retention, and the change in interest expense with the resulting marginal savings. You can see that the more rate sensitivity you have, that is, the fewer balances you retain and the more balances that are at risk, the smaller your marginal savings. Next slide. As I stated earlier, we're in a very low rate environment. Your loans must be priced at a cost and risk adjusted basis. You have very strong competition for those loans, and therefore your margins are being squeezed. So we need to evaluate how to squeeze out more profitability from the liability side of the balance sheet, which are your deposits. And very often, it's low-hanging fruit. Competition is fierce here as well, though, and retaining and growing deposit balances require more sophisticated tools to developing pricing strategies and product development. So let's start with the retailing tools of market segmentation and product differentiation in order to minimize balance sheet cannibalization. I told you I'd use those words ad nauseum. Start with a Decile distribution for all organic deposit products and build a profile of large balance customers. Estimate their rate sensitivity and product needs based on that profile. Optimize your interest expense savings by evaluating the marginal benefit of lowering rates in this rate environment. Yes, marginal cost and savings analysis is time consuming and assumption driven. I've gone over that, but it's really a tool that's necessary to evaluate the true impact of your pricing decisions. Understand that all larger financial institutions use this analysis, and there's no reason that community banks can't do the same thing. Your strategies will be different based on your strategy to retain or grow non-maturity deposits. And also, what are your strategies relative to CDs? You should be prepared to pay up for rate-sensitive balances, but not for non-rate-sensitive balances. This will require you to develop new products with barriers to entry, or maybe new balance tiers. Elite pricing based on higher balances is an efficient strategy regardless of the deposit type, and it permits you or allows you to pay up for those rate-sensitive balances, not non-rate. Using Federal Home Loan Bank advances to supplement deposit balances or to reduce your marginal cost of funding is a very efficient pricing strategy. There are many retail strategy tools to help you reduce your marginal cost of funds, and you need to use them in order to compete effectively in the retail market today. I've thrown a lot of information at you, so Tom Tino, maybe we can open it up to questions at this point.
Sure, Janet. Thank you for the presentation. Folks, so for those of you listening, there's a question box on the right hand of the screen. Please feel free to continue to pose some questions. We have a few. Janet, let's have a question for you from myself, just to start. You were talking about a 90% retention rate as being on the safe side here. I know as the rates get lower, there's a lot of consumer indifference to the rate being paid. In the prior financial crisis, it seemed that the strategies you had recommended resulted in very little runoff. Was the 90% runoff consistent with the last financial crisis, or is that being on the safe side?
Well, as I had said earlier, depending on the rate environment we're in, it will definitely drive the rate sensitivity and the liquidity needs of your customers. So in a higher rate environment, if my weighted average cost of funds for non-maturity deposits were, let's say north of 1%, now there's a different thinking involved. Customers, you can expect that your customers have a different level of rate sensitivity and the rate that they're willing to get on their liquidity account. So probably if I were evaluating it in a higher rate environment, I would place more rate sensitivity there. I might start with a 15% at-risk balances. But the beauty of having a model is to do a wide spectrum of what if, and building a customer profile is going to help you understand what the behaviors are of your higher balance customers in different rate environments. When rates were higher, were most of their balances in CDs? When did they start moving to money market accounts? So it's understanding the profile and also understanding the level of interest rates and how fast rates are moving.
Okay, thanks, Janet. One follow-up question. When managing the deposits from a marginal cost perspective, one possible solution is to backfill with home loan bank advances. Now the advance curve is so flat. Are you looking at what kind of deposits migrating out? Like, so say if a non-maturity deposit that's labeled as a core deposit, if that is migrating out or experiencing some outflow, would you be inclined to backfill with longer-term advances, considering it's a very flat yield advance curve right now, or would you stick to rolling short?
I run the analysis through my marginal cost model, but with advances rates as low as they are and as flat as they are, for longer term money, paying 75 basis points for 5-year money, I would definitely opt to use advances for supplementing my organic deposits. My business partner, Dr. Tom, has always stated, if you are 100% funded through retail deposits, you are paying too much at the margin. And we can prove that almost every time when we run the marginal cost. But without a marginal cost model, it's hard to prove that. I just want to throw out one thing here, because examiners sometimes see home loan bank advances and a red flag goes up. They may look at the fact that your nominal retail deposit rate is lower than the nominal advance rate. What they don't see is the impact of shifting balances on the balance sheet. It's not taken into consideration at all. And that's what can give you a much higher marginal cost. I keep going back to marginal cost analysis because that's what's going to show it. That's that critical analytical tool. And if you do this, that's the data that you put in your ALCO minutes, your board meeting minutes, your pricing committee minutes, and be able to give to your examiner. This is how we evaluated our cost of funds and home loan bank advances. And because of product mix changes at the margin, it was much less expensive for us to use home loan bank advances to supplement organic deposit growth.
Okay, Jen, and one thing to note when members are looking at the coupon of the advances that they're considering, so like Janet said, we have a 5-year advance of approximately 75 basis points. Don't forget to factor in the impact of the FHLBNY stock dividend, because when you do the math, the stock dividend offsets an advance of that size or that coupon by around 21 basis points. So you're really borrowing at 54 basis points as opposed to 75.
That's an excellent point, Tom. Excellent, yeah.
Yeah. All right, so one of the members' questions, what kind of things do you look at when developing a deposit profile of large balance customers?
Okay, so we first have to assume that you have some kind of a customer information file system. And I noted that can be challenging for some of you, and you might have to jump through some hoops to get there. But please get there if you're not there already. But let me go with that assumption. You know, if we use the money market example that we saw on slide 4, Alyssa, could you switch back to slide 4 here? We had 449 different money market accounts with high balances, recognizing that some of those customers will be duplicate customers. You know, somebody might have 4 different money market accounts. But if you can develop a customer information report that shows you the different products and balances and opening date of the deposit products for those customers, and which also shows you the product mix and change in balances. And I would start with the 90 customers that have balances of $250,000 or more. Get your branch staff involved, as many of them know your customers, and their anecdotal knowledge here will be very, very useful. It's a first step in developing a customer profile report. Now, let me take it one step further, though, because you may want to add an additional high-touch approach where you contact high-balance customers, you thank them for their business, and ask for the additional balances. They're going to like being asked for additional business. So if you look at 250,000 or more that we see on this particular Decile distribution, we have 90 accounts. And if you have a staff of 5 that can be dedicated to this project, then each person would be assigned about 18 customers. Develop a script so that they can call these customers, set a 3-month time frame, which would be about 6 calls per month per person. Certainly very manageable. And ask them for more of their business. Ask them for what they need in the way of product lines. again, many customers are going to embrace this high-touch approach and probably be willing to bring you more balances. It's always easier to get wider share of wallet from current customers versus brand new customers. They already know your institution.
Okay, thanks, Janet. And you kind of hit upon it here when you're showing the Decile distribution. But what do you consider the first step in starting a marginal cost analysis? What are the first steps? Is it the Decile distribution, and what comes next?
Oh, okay. Well, yeah, marginal cost, as I had stated, can be pretty intimidating, but keep in mind that it's really simple arithmetic. If you sort of follow the spreadsheet, Alyssa, I think it's go up a couple of slides to the scenario 2. Yeah, thank you. So I would recommend follow this spreadsheet. It's easy math, and you can purchase expensive models to do the analysis for you, but I would suggest that you would start with a simple spreadsheet. Your current scenario is your starting point. What are your various organic deposit products? What are the amounts? What are the weighted average costs of each one? Let the model calculate your annualized interest expense. And then your second scenario is your what if. How do you want to lower or raise your rate? What are the assumptions there? At a best estimate, and certainly based on a profile of customers, what percentage of balances would be retained? Again, the model will calculate the rest. The two scenarios are compared, and the marginal cost or savings is calculated. But by running various assumptions, the way you would do with budgets and interest rate risk projections, it's like anything else. The more you work with it, the easier it gets. But marginal cost is pretty simple arithmetic. It's just getting the assumptions behind everything. But you have to do it with your budgets and interest rate risk modeling too.
Okay. Well, thank you, Janet. That concludes our questions today. We really appreciate this informative webinar that you've presented to us. I just want to plug our next webinar. It's August 13th. It's going to be conducted by Ray Chandonnet. Many of you may know Ray from his work at Sandler O'Neill. Over the years, he's with a new tech firm called Neocova, and he's going to be speaking about how smaller community banking institutions can embark on their technology journey. What steps they could take to bolster technology and remain relevant and competitive in this environment. So I think that's going to be a great one. I've been talking to Ray a lot about it. He's got a lot of great information. So again, August 13th at 11 a.m. and hopefully we'll see you then. We'll be sending out an invite shortly on that so you can put it in your calendars. All right, so that concludes our webinar today. Thank you everyone for attending, and again, thank you very much, Janet.
Thank you.